Banking in ancient Babylon represents one of the earliest and most sophisticated financial systems in human history. A world where clay tablets served as contracts, temples acted as vaults, merchants extended credit across vast trade routes, and interest, one of the most consequential inventions in economics, emerged not as an abstract formula, but as a practical solution to the challenges of agricultural cycles, long-distance commerce, and the unpredictability of life in the ancient Near East. To explore Babylonian banking is to step back into a civilization that understood, thousands of years before modern finance was born, that wealth was not merely a matter of possession, but of agreements, obligations, and the management of future uncertainty. Babylon's financial system developed from the interplay of religion, law, and trade. Temples and palaces, the twin centers of authority, initially controlled economic activity. Farmers deposited grain in temple storehouses, which acted as the earliest banks by offering secure storage and issuing receipts that functioned as transferable claims. Over time, private merchants joined the system, offering loans, safekeeping, and credit instruments that laid the foundation for commercial finance. The agricultural nature of Mesopotamian society made lending essential. Crops required months to grow, irrigation systems needed maintenance, and droughts or floods could devastate entire harvests. Credit allowed farmers to plant in spring even if they lacked seed or equipment. Loans were typically repaid after harvest, reflecting the seasonal rhythm of ancient economics. Interest emerged naturally from this system, not as exploitation, but as compensation for risk. A lender who provided seed or silver took a gamble on weather, pests, or theft. Interest balanced that risk. Rates varied depending on whether the loan involved grain or silver. Grain loans, more vulnerable to spoilage and transport risk, commanded higher interest, often 1/3 of the principal. Silver loans commonly carried rates around 20% annually, a standardized figure that persisted for centuries. The Code of Hammurabi, one of the earliest law codes in history, regulated interest to prevent abuses. It set maximum rates, defined collateral rules, and established penalties for fraud, default, and negligent lending. These laws reflect a sophisticated understanding of finance, that credit fueled economic life, but unchecked lending could destabilize society. Through regulation, Babylonian rulers sought to balance opportunity with fairness. What makes Babylonian banking extraordinary is not merely that loans and interest existed, but that the entire system displayed remarkable legal and contractual complexity. Clay tablets, inscribed with cuneiform, acted as binding contracts. These tablets recorded principal, interest rates, collateral, repayment terms, and the identities of witnesses, creating a transparent and enforceable financial culture. Some tablets included clauses specifying penalties for late payment, protections against crop failure, or the transferability of debt obligations. Loans could be secured by fields, houses, livestock, or even family members, though debt bondage, where a borrower temporarily offered labor or the service of a household member, was regulated to prevent permanent enslavement. In this world, credit was not merely economic. It was intertwined with social relationships, honor, and community standing. A borrower who defaulted risked not only legal consequences, but social disgrace. Babylon's merchants enhanced the system further by developing financial instruments suited for long-distance trade. Caravans traveled between Mesopotamia, Anatolia, Persia, and the Indus Valley, carrying wool, metals, timber, spices, and luxury goods. Transport over thousands of miles was dangerous, expensive, and unpredictable. To mitigate these risks, merchants used credit partnerships. A trader might receive silver from a financier, travel to a distant region to purchase goods, and return with profits that were shared under a predetermined contract. These arrangements resemble modern investment partnerships, with risk and return distributed between parties. In some cases, merchants issued promissory notes, early forms of checks, allowing traveling traders to avoid carrying large sums of silver. This innovation reduced theft risk and facilitated international commerce long before paper money appeared. Temples continued playing a central role in Babylonian finance even as private banking matured. They acted as trusted intermediaries and custodians of wealth. Because temples were considered sacred and under divine protection, deposits held there were secure from seizure during political upheavals. Temples also managed large estates, employing laborers, renting land, and issuing loans. Their financial activity blurred the lines between religion, government, and commerce, creating an ecosystem in which faith and finance reinforced one another. The concept of interest itself was often described in cosmological terms, linked to natural growth and the cycles of life, suggesting that borrowing and lending were woven into the spiritual fabric of Babylonian society. One of the most intriguing aspects of Babylonian banking is debt relief. Throughout history, debt has had the potential to destabilize societies. When too many citizens became indebted, social inequality grew, laborers lost freedom, and unrest simmered. Babylonian kings recognized this danger. Periodically, rulers issued misarum or andararum, decrees, proclamations, canceling debts, freeing debt slaves, and returning property. These decrees served not as acts of charity, but as pragmatic economic resets designed to preserve social stability and maintain the productivity of the population. Their existence shows that the Babylonians understood something modern societies often debate. Debt can be both a tool and a trap, and its management has profound political consequences. Despite this occasional intervention, everyday financial life in Babylon remained highly structured and surprisingly efficient. Banking houses run by entrepreneurial families kept accounts, issued loans, traded commodities, and partnered with merchants. Some families became powerful financial dynasties, their archives revealing thousands of tablets documenting centuries of transactions. These archives show that Babylon's economy was not primitive, but highly monetized. Silver served as the primary unit of account, even when actual payment occurred in grain or labor. Prices for goods and services remained remarkably stable across centuries, suggesting that Babylon had a firm grasp on monetary discipline. Interest itself evolved conceptually during this period. What began as compensation for risk became an economic principle that shaped trade, savings, and investment. Babylonian society understood the time value of money long before modern economists articulated it. A lender parted with silver today in expectation of greater silver tomorrow, a recognition that money possesses potential beyond its immediate use. This insight helped Babylon move beyond subsistence economics toward a system capable of supporting complex markets, specialized labor, and long-distance networks. Yet the sophistication of Babylonian finance coexisted with its vulnerabilities. Droughts, wars, and political shifts could disrupt trade routes and destabilize credit networks. Debt crises occasionally arose when farmers suffered repeated crop failures. Foreign invasions by Hittites, Assyrians, Persians periodically disrupted or transformed financial institutions. Still, the basic principles pioneered in Babylon endured. Loans, interest, contracts, collateral, deposits, and credit partnerships form the backbone of finance even today. The system that began with clay tablets evolved into scrolls, then parchments, then ledgers, and eventually digital databases. But the underlying logic remains recognizable. Understanding Babylonian banking thus illuminates the roots of modern finance. It shows that credit is not a modern invention, but a timeless human response to scarcity and opportunity. It demonstrates that interest was not born from greed, but from risk-sharing. It reveals that financial contracts emerged not from theoretical design, but from practical necessity. And as we study this ancient system, we see how deeply our own financial world is connected to the distant past, how the logic of loans and interest echoes through millennia, and how humanity's earliest attempts to structure economic life laid the groundwork for the global financial architecture we depend on today, showing that even in the earliest civilizations, people understood that managing the future required tools more sophisticated than barter and agreements more enduring than simple verbal promises, revealing a civilization that understood with surprising clarity that the future could be shaped if only one possessed the right mechanisms of trust, obligation, and recorded certainty. In the second phase of this story, the focus shifts from the structural mechanics of Babylonian banking to its deeper implications. How these early financial systems influenced culture, power, social hierarchy, and the evolution of economic thinking. How the concepts of debt and interest shaped personal relationships as much as political ones, and how Babylon's innovations echoed far beyond Mesopotamia to influence Hebrew law, Greek philosophy, Roman finance, and ultimately the foundations of the modern monetary world. One of the most profound societal effects of Babylonian finance was the institutionalization of obligation. A loan was not merely a transaction, but a binding social tie, recorded in clay and witnessed by the community. Debt connected people across time, creating expectations that stretched into the future. In a world without banks as we know them, these obligations were personal. Families borrowed from one another. Merchants lent to farmers. Temples lent to entire communities. Debt tied households into webs of mutual dependence that could either create prosperity or generate hardship. A family that borrowed wisely could expand its land, invest in more crops, and rise in status. A family that suffered repeated misfortune could slide into bondage, risking the temporary loss of labor or property. Debt thus became a force that shaped social mobility, reinforcing hierarchies even as it offered pathways for advancement. The moral dimension of debt was equally important. Babylonian society viewed lending and borrowing as natural but potentially dangerous. Too much debt could tear communities apart. Too much power concentrated in creditors could ignite resentment. This is why kings intervened periodically through Andurarum decrees, acts that canceled debts and restored freedom. These resets served as political safety valves, preventing creditors from gaining excessive control over labor and land. They also reveal a sophisticated awareness that economies can become fragile when burdens grow heavier than people can bear. Modern policymakers still debate the same questions. When is debt productive? When is it predatory? And how should societies balance creditor rights with social stability? Babylon faced these dilemmas first. Interest itself carried symbolic meaning beyond mere compensation. The Babylonian understanding of interest was rooted in metaphors of growth, fields yielding crops, herds producing offspring, rivers swelling and retreating. Interest was conceptualized as the offspring of money, a reflection of nature's rhythms. This worldview shaped how Babylonians justified financial returns. It also underscored the expectation that money, like life, should be productive. This early philosophy helped transition human societies from subsistence economies toward investment-based thinking. The idea that one could deploy resources today in pursuit of greater resources tomorrow. Such thinking underlies everything from savings accounts to modern venture capital. But while interest was widely accepted, Babylonian law sought to restrain its excesses. Hammurabi's code did not outlaw interest. It normalized it, regulated it, and placed boundaries around it. Maximum rates ensured lenders could not exploit borrowers. Penalties for irresponsible lending kept financiers accountable. Rules about collateral protected families from losing generational land unjustly. These legal constraints show a remarkable balance. Babylon embraced financial innovation while recognizing the need for ethical oversight. Modern societies often struggle with the same balance, caught between protecting vulnerable borrowers and preserving the freedom of financial markets. The interplay between religion and finance also shaped the Babylonian worldview. Because temples were economic hubs, financial transactions carried sacred undertones. When one deposited grain in a temple granary, it was under divine protection. When loans were issued, the gods were implicitly witnesses. This infused finance with moral weight. Default was not only a legal failure but a spiritual breach. The divine oversight of contracts helped stabilize trust in a world where secular institutions remained weak. As secular governments strengthened in later civilizations, this role would shift to courts, auditors, and banks. But its origins lie in these early sacred financial systems. Babylon's financial innovations also radiated outward through cultural and political influence. Hebrew law adopted many Babylonian concepts, including limits on interest and periodic debt forgiveness, the Jubilee. Greek philosophers studied the moral implications of interest, often criticizing excessive usury. Romans expanded credit systems, mortgage laws, and banking practices informed by earlier Mesopotamian models. In this sense, Babylon functioned as the intellectual ancestor of Western finance, shaping debates that would continue for millennia about the ethics, purpose, and dangers of money lending. Another overlooked aspect of Babylonian finance is its impact on gender and family structure. Women in Babylon could own property, engage in commerce, and enter contracts. Clay tablets record women acting as lenders, borrowers, and business partners. Though patriarchal norms limited full equality, Babylon offered financial agency to women unmatched in many later societies. This suggests that developed financial systems tend to expand participation and redistribute power, not always evenly, but often more broadly than rigid traditional structures allow. Trade networks reinforce these social dynamics. As merchants traveled with promissory notes instead of bullion, finance became a vehicle for cultural exchange. Babylonian methods spread across caravan routes, influencing neighboring economies. Over time, financial literacy became a mark of sophistication. The ability to read contracts, calculate interest, and manage risk elevated merchants into a distinct social class whose influence rivaled that of landowners and priests. The rise of commerce shifted the balance of power within Babylonian society, laying early groundwork for the later emergence of cosmopolitan merchant cultures across the ancient Mediterranean and beyond. Despite its strengths, Babylonian finance also revealed its vulnerabilities in times of crisis. A series of poor harvests could trigger widespread defaults. Wars could disrupt trade routes and make loan enforcement impossible. Shifts in political power could render existing contracts void. Yet each crisis produced innovations, new rules, new practices, new instruments that strengthened the system. This cycle of stress and adaptation mirrors the evolution of finance across history. Every crash teaches lessons. Every disruption reshapes the architecture of trust. By examining Babylon's financial world, we also gain insight into how human beings grapple with uncertainty. Finance existed because the future was unpredictable. Interest existed because risk was real. Contracts existed because memory alone could not guarantee fairness. These early tools of trust allowed Babylon to move beyond the limitations of barter and create a complex economic system capable of supporting cities, trade, and cultural achievements that still inspire awe. And as the world evolved, the logic of Babylonian finance did not vanish, it transformed. Bills of exchange in medieval Europe, letters of credit in Renaissance Italy, bonds in Enlightenment markets, and digital loans today all reflect the same fundamental principles carved into clay thousands of years ago. In the end, the story of banking in Babylon reveals that modern finance is not a sudden invention, but a continuity along intricate inheritance shaped by ancient farmers calculating harvest cycles, merchants crossing deserts, priests guarding grain, scribes etching promises into clay, and kings balancing justice with stability. The foundations laid in Babylon continue to echo in every mortgage contract, every interest rate, every loan agreement, and every financial institution that governs our economic lives. It is a reminder that while technology changes, the human need to create order, trust, and possibility through financial tools remains constant, connecting us across time to the earliest architects of economic civilization. Completed. Human beings could overcome the limits of direct exchange by creating symbolic systems of value that allowed cooperation to stretch across space, time, and uncertainty. In the second phase of this story, the narrative widens its lens to explore how these early monetary innovations reshaped societies at a deeper level, how money altered social hierarchies, political structures, cultural identities, and the rhythms of everyday life, how the mechanics of trade influenced ancient worldviews, and how the foundations laid by early civilizations created the blueprint for every monetary system that followed, from medieval markets to the digital economies of today. One of the most profound consequences of the birth of money was the emergence of economic specialization. Before money, most people produced much of what they consumed. Barter limited the division of labor because individuals could only trade with those who had precisely what they needed. But once societies adopted standard mediums of exchange, specialization flourished. A potter no longer needed to find someone who wanted pots at that exact moment. She could sell her wares for a commonly accepted form of money and then purchase whatever she desired. This transformation allowed entire classes of artisans, traders, scribes, and administrators to emerge. Cities grew because people no longer needed to farm for survival. Urban professions, builders, priests, merchants, metal workers, artists became viable as money enabled them to trade their skills for food and resources produced elsewhere. Money also reshaped social hierarchy. In barter economies, wealth was often measured in land, livestock, or stored harvests. But once symbolic forms of value became widespread, wealth became more fluid and more concentrated. Those who controlled temples, mines, or trade networks accumulated enormous economic power. Rulers minted coins bearing their images not simply to facilitate commerce, but to project authority, reminding subjects daily of who guaranteed the value of their currency. The connection between political legitimacy and monetary authority became a defining feature of ancient governance. To control money was to control the state itself. When empires expanded, they imposed their currency on conquered regions, thereby integrating them into a unified economic sphere. Money was thus both an administrative technology and an instrument of empire building. The psychological impact of money was equally significant. Money changed how societies understood value, fairness, obligation, and even morality. Debt, in particular, acquired moral weight. To owe someone was not just an economic fact, but a social and ethical state. Ancient literature, from the Epic of Gilgamesh to early Hebrew texts, frequently invoked themes of debt, obligation, and redemption. These stories reflect an intuitive awareness that money introduces asymmetries of power, shaping personal relationships in ways barter never could. In religious texts, debt metaphors described sin and forgiveness. In political life, rulers who canceled debts were celebrated as liberators. Money became woven into the moral fabric of society. Trade networks expanded dramatically as monetary systems matured. Once portable and universally accepted stores of value emerged, merchants could travel farther, transact faster, and finance expeditions more reliably. The Silk Road connected China, Central Asia, India, Persia, and the Mediterranean, transforming Eurasia into a vast economic ecosystem. Along these routes, money forms mixed and influenced one another. Roman gold coins circulated in India. Chinese bronze coins reached Southeast Asia. Persian derricks traveled as far as Greece. Trade brought wealth, but also ideas, religions, technologies, languages, and artistic styles. Money was both the engine and the pathway for this exchange. The evolution of money also spurred advancements in record-keeping and bureaucracy. As transactions grew more complex, societies needed ways to track debts, taxes, wages, and inventories. This requirement led to writing systems in Mesopotamia, to hieroglyphic accounting in Egypt, to sophisticated administrative tablets in Persia, and to inscribed stone records in ancient Greece. The bureaucratic machinery of early states was funded by and built to manage monetary flows. Taxation required standardized currency. Armies required stable pay. Infrastructure projects required budgeting. Money did not merely enable these institutions, it shaped them. At the household level, money introduced new rhythms of life. Instead of seasonal barter cycles, families began to navigate monetary calendars. Rent payments, temple dues, taxes, loan repayments, wages, market days became central nodes of social life. Urban residents bought bread, oil, beer, tools, clothing, often with coins or temple-issued receipts. This shift created a new kind of economic consciousness, one in which value was measured and compared numerically. Prices emerged, wages stabilized, and economic planning became possible. People could save for the future, invest in tools or land, or accumulate resources for marriage, dowries, and inheritance. Money made intergenerational wealth transfer more predictable, reinforcing family structures and long-term planning. But money also magnified inequality. Those with surplus wealth could lend at interest, buy land from distressed farmers, or control trade routes. Wealthier households diversified investments while poorer families became vulnerable to debt cycles. Ancient societies responded with different strategies. Babylonian rulers issued periodic debt cancellations. Hebrew law prohibited interest within the community. Athens developed democratic institutions partly to counterbalance aristocratic economic power. Rome expanded citizenship and land rights while simultaneously using coinage to pay its vast armies. These responses reveal how deeply intertwined money was with political philosophy and governance. Another critical development was the interplay between money and religion. Temples in many ancient civilizations acted as financial centers, and religious rituals often involved offerings of precious metals, grains, or livestock. In some cultures, money gained sacred overtones, with coins bearing images of gods or divine symbols. This sacralization of money strengthened trust in currency, but also provoked debates about morality, greed, and materialism, debates that persist today. Philosophers such as Aristotle criticized the unnatural accumulation of money, arguing that its purpose should be limited to facilitating exchange, not generating profit. Others embraced money as a tool for justice, stability, and social order. As trade expanded, technologies of protection evolved. Locking mechanisms, scales, standardized weights, seals, and anti-counterfeiting measures became widespread. Some societies embedded codes or patterns into their coins. Others enforced severe penalties for counterfeiting. These innovations underscore the central paradox of money. Its power depends on trust, yet trust must continually be defended against those who seek to exploit it. Over time, money became the connective tissue of the ancient world. It allowed empires to scale, merchants to prosper, cities to flourish, and cultures to interact. Even when civilizations collapsed, when drought struck, armies invaded, or dynasties fell, the idea of money survived. Its forms changed, but its logic endured. That endurance is a testament to its utility and to humanity's continual refinement of systems that reduce friction, facilitate cooperation, and expand possibility. In the long arc of history, the birth of money marks a turning point in the human journey. It represents the moment when societies learn to transcend the immediacy of barter and embrace abstraction. It marks the emergence of value as a shared narrative rather than a physical object. It marks the beginning of economies capable of supporting monumental architecture, standing armies, scientific inquiry, long-distance trade, and the cultural achievements that define civilization. And it laid the foundations for every monetary innovation that followed: paper currency, banking, credit, digital payments, each built upon the ancient realization that trade becomes easier, life becomes more stable, and society becomes more expansive when people share a common language of value. Ultimately, the story of how ancient civilizations traded is the story of humanity learning to coordinate dreams and resources across vast distances. Money turned trust into a portable technology. It turned scarcity into opportunity. It turned exchange into a force capable of shaping empires. And though the forms of money continue to evolve, its essence remains unchanged, a collective promise that enables human beings to build worlds together, transforming simple acts of barter into the complex, interconnected, and imaginative systems that define economic life today. Completed.